Good morning, Mr. and Mrs. Kemp. Thank you so much for joining me today. It's a pleasure to see you both. And thank you also for working hard at getting the documents and necessary information back to our firm. I know that it might have been a little labor intensive going through that process and the data gathering process that is so necessary for us to understand your current financial situation. And so what we'll go through in today's meeting is really reviewing your current financial situation. I'll provide some recommendations from our firm and the next steps and if you wish to implement those recommendations, what the next steps for you would be. So I'll go through and also recap some of the assumptions that we've made in the financial plan as well. So just to summarize first, I have that both you and your wife are now retired, fully retired. So congratulations. This is quite an exciting step, and rest assured that we're going to be here to really help with this next phase, really your wealth preservation phase, looking at distribution strategies. Also, a big focus will be on income tax and estate planning strategies and how we can minimize taxes in your overall financial situation. I have also that you have 2 children, Stephen and Robert, and you have 3 grandchildren, Michael, James, and Sarah. Now, from the last time that we met, from the last time that we gathered your financials, has there been anything substantial that has changed in your financial situation that you wish to share with me today? Okay, all right, great, thank you. So really, the purpose here and what you've tasked our firm to do is to provide a comprehensive financial plan. So this financial plan really is the framework that helps you reach your financial goals and improve your financial situation, which I must say is quite great to see such a solid plan already. So you guys have really taken, Mr. and Mrs. Kemp, you both have taken some great steps in protecting your financial situation and setting yourselves up for success for this retirement phase. So kudos to you. In this plan, we're going to go through different sections, and you have a copy of this as well, so you can follow along as we go through it. And I'm going to keep it a little bit at a high level right now, but certainly if you have any questions or want to dig deeper into the plan, please let me know and I'll be happy to, and we'll be able to go through that. But for this, I'm going to keep it a little bit of a high level as we go through this. All right. So the different sections, we're going to go through your financial health, risk management, investment planning, retirement planning, tax planning, and estate planning. Really, last time we worked as well, we went through a goal setting worksheet, and that really helped our firm look at all the goals that you have and prioritize them. So starting with the first, with your estate and gift tax liabilities, reducing that and ensuring that your estate planning documents are in order. Also reviewing your insurance contracts and discussing any implications of purchasing a long-term care policy, establishing a college funding plan for the 3 grandchildren, reducing your personal income taxes, and then based off of your risk tolerance level, recommend a diversified portfolio that meets your needs and expectations. Now, one thing with the risk tolerance level that I want to pinpoint is we did not receive the completed risk tolerance questionnaire. No problems, we'll be able to go through that. I just wanted to let you know in this plan, we've made the assumption, and based off just conversation, that you're very willing to take on investment risk to grow your investments. Our firm likes to dig a little bit deeper on that and go through a questionnaire that really will ensure that you have the full understanding of what that means with your investment assets, and you understand the risk that you're taking on for the potential for the higher return. So we recommend that you do complete that risk tolerance questionnaire. We have included assumptions or recommendations based off of an assumption of an aggressive level of risk for each of you, but that will just be one step that we do want to take care of, really to ensure that we are all on the same page on what the level of risk is that you would like to take. Some current economic assumptions that we've made in retirement is you expect to be in the highest marginal tax bracket of 37%. You expect inflation to be 2.85%. The risk-free rate is 3%, and the market risk premium will be at 7%. When it comes to your financial health, in your current financial situation, we report a net worth of $13,500,769 and net disposable income of $1,528,833 this year. Now that includes the one-time cash inflow of the $1.2 million from the sale of the business. So for planning purposes, since that's not going to happen each year, we plan off of the annual disposable income of $328,833. So you've both done a fantastic job of accumulating a sizable net worth, and now we need to make sure to protect it and maximize maximize this next phase as efficiently as possible as well. When we look at financial ratios to measure the financial status, they're very good, extremely well. So the current ratio, which compares your assets to your liabilities, is quite high. So we typically see like to see a benchmark of 2, and you're at 52.76. So while we want it to be strong, and you certainly do have a strong financial current ratio, that also leaves an opportunity to use some of that cash for to earn a higher rate and have it so that you're not losing so much on your purchasing power with those funds, because so many funds in an account that isn't growing at the rate and keeping up with inflation is really like having a leaky bucket when it comes to your liquid assets. So we don't want a leaky bucket with your assets. So we're going to go into some of the recommendations that our firm has regarding that. So with an emergency fund, we typically like to see or recommend 3 to 6 months of expenses saved up. As you're going into this next phase and have fixed income, we would recommend a 6-month emergency fund, so 6 months of expenses saved up as an emergency fund. So for you, that's $189,612, and currently you have $1.13 million, which is a significant surplus of $940,388. And then if we add in cash that you have in the cash value of Mrs. Kemp's life insurance, that creates an even larger surplus. So for planning purposes, we're going to use the surplus amount of the $940,000 approximately, and a couple of recommendations for how to use this excess cash that I'll go through in just a high level here. One would be paying off the mortgage on the vacation home. So with the amount of cash that you have, there's really no need to be carrying that mortgage, and you can enter into this next phase completely debt-free. And to keep on that same debt-free or to continue to be debt-free while in this retirement phase, we would recommend temporarily keeping some cash aside to pay for the new vehicle in cash. Additionally, in order to support your travel, and I love that goal, by the way, my husband and I love to travel. Hopefully we'll be able to do more of that coming up soon. This year has been quite a doozy in these unprecedented times. But to support your yearly travel, we recommend laddering some certificates of deposit so that you have money come due each year, so that you can use those funds to for your travel wants and needs that you have. Additionally, we also would recommend fulfilling one of the main goals that you have in establishing a college fund for the 3 grandchildren. So you can contribute the maximum if you choose to gift split, then that would be $150,000 per child. So that takes up a large portion of that excess emergency fund as well. In addition, we would also recommend using those funds to pay for some costs and improving your financial plan, such as estate planning costs, which we'll get into a little bit later, and then also investing in the market in a dollar cost averaging method. Now, for the funds that you have and that you would keep as your emergency fund, we would recommend a 3-tier approach our firm uses, where you would keep 1 month of expenses in your main checking account. Then you would use the next 2 months of emergency funds in say a money market fund or a certificate of deposit with maturities less than 6 months. And then the remaining amount of remaining amount of emergency funds would be in, you could put in a certificate deposit, 1 to 3 years, or a 3-year fixed deferred annuity as well. So that takes care of your financial health when it comes to looking at your balance sheet and your cash flow statement as well. Any questions regarding that? Right. Yeah, absolutely. That's exactly right. So it's important to have cash, but having too much cash can actually be a risk to your plan. So that's why we've made those recommendations. Yes, sir. All right. Perfect. Well, moving on, looking at your risk management. So here what we've looked at is we've done a full insurance analysis to take a look at all of the policies that you have. Now, a couple of strengths: the vacation homeowners policy that you have is adequate. So we want to have coverage where your residence would be covered for at least 80% of the replacement cost, and your vacation homeowners policy certainly does that. So great job there. In the event of we ran a scenario that in the event of $100,000 loss, you'd be fully covered, would only have to pay your insurance deductible. So great job there. Now with the homeowners policy, that's where we have an opportunity to bring up that coverage so that you do have the adequate coverage. Right now you are underinsured with the homeowners policy, so we would recommend additional coverage there. And one of the big risks that we found was with the personal auto policy. We only found one policy. So I just want to confirm with you if that is the case, or if we might have missed something by chance. So is it correct that you only have one personal auto policy? Okay. Okay. All right. So in that case, we would recommend strongly to make sure to have a personal auto policy, to obtain a personal auto policy on the uninsured vehicle. That is a large risk to the plan, especially in the state of New Jersey, which is a litigious state. We want to make sure that you're properly insured. On the current coverage that you have, it covers for $200,000 per person for bodily injury, $600,000 per occurrence for bodily injury, and $15,000 for property damage. We would recommend increasing the property damage coverage to $100,000 to ensure adequate coverage in the event of an exposure. And with the new personal auto policy that we recommend that you do obtain, we would recommend mirroring the current personal auto policy recommendation to the new policy. Also, the umbrella policy that you have, while it's great that you have an umbrella policy, love to see that when our clients of high net worth like yourselves, we want to make sure that it is adequate for the risk that you have with the large personal wealth. So with that, we would recommend an additional amount be purchased so that your coverage would increase to 12 million. With the health insurance policy, I know that you were previously covered through your husband's work, and that's where you had your healthcare coverage. Now, coming on to Medicare now, Medicare does require that you carry credible prescription drug coverage in order to avoid having a late enrollment penalty. So we would recommend having a Medicare Part D, D as in Delta, prescription drug coverage plans to avoid that late penalty. Also, you both are very healthy right now, and that's fantastic. And this would be the best time to look into a Medicare supplement plan should you want to go that route and not self-insure. You certainly have the assets to self-insure. However, having a Medicare supplement plan, a comprehensive one like Plan F, can provide you with peace of mind knowing that your Medicare hospital and Medicare medical needs would be covered. Your 20% out-of-pocket costs would be covered through the Medicare supplement plan. So we'll review that more in detail as well. The life, also, my apologies, the long-term care policy, I'm glad that you brought that up and that we are all on the same page with that, since that could be a very large risk when it comes to retirement, is long-term care cost. And we did find a policy for you that we would recommend, and it helps protect your assets against the risk of high cost of extended long-term care. And this policy is a comprehensive policy. It will allow each spouse to share in the other spouse's policy benefits. The benefits would be paid for 3 years or up to $360,000, whichever comes first. And the annual premiums would be $5,250 for John and $4,000 for Mary. Finally, a life insurance analysis was conducted. Now, the current policies are adequate. And with this, in our next meeting, we'll have a further discussion to see how is it that you would want life insurance to really fit into your plan. And what I mean by that is most times life insurance is used as a means to protect against liability, income, funeral costs, or education expenses. And for both you and for both you, Mr. and Mrs. Kemp, we don't see a need for life insurance for those traditional reasons. Life insurance in your case could be used to for estate planning and tax minimalization strategies. And with that, I would want to bring in your estate planning attorney and also your tax accountant so that we can have a comprehensive conversation regarding how we would want to use life insurance in your plan. So we'll review this further in our upcoming meeting. Any questions regarding the insurance analysis? Okay, great. So moving on to the investment analysis. So we did find that the current investment situation has some weaknesses that we would like to address. When it comes to the non-qualified stock portfolio and also Mr. Kemp's 401k, we did find that it's not diversified. When we looked at the total non-qualified portfolio, which is the combination of the stock and mutual fund portfolio, it is underperforming on a total risk basis as measured by one of our financial measures that we use. It's also important to note that we want to make sure, again, that you understand the potential implications of the very aggressive risk in the portfolio as well, to ensure that you are indeed willing to take on the level of risk and able to weather the storm, so to speak. Especially if you think about this year and how we had a sharp market downturn in March. Would you have been able to weather that storm? And when we go through our risk tolerance questionnaire, as I have touched on before, we'll go through hypotheticals like that to really assess what the proper risk tolerance is. To improve the investment position, we would recommend diversifying the stock portfolio, as it currently only has 4 stocks. We'd also recommend implementing a tax harvesting strategy that we could use when we reallocate the portfolio. We would recommend dollar cost averaging into the portfolio using the excess emergency funds, also the proceeds of the installment sale, as well as the future payments with that. Since you are in a higher tax bracket, we suggest that you build a diversified portfolio using ETF or exchange traded funds, mutual funds with low turnover and tax efficiency. Our firm can certainly help in this area. So we do recommend that once we have the risk tolerance nailed down, that from there we can develop an asset allocation strategy that matches that level of risk and provides those returns in a tax efficient manner, is more diversified, and really, again, matches your level of risk there. When it comes to, we also would recommend that the dividend preferences will be changed to reinvest instead of cash dividends, because there's no need for any additional cash. We can just continue to reinvest that dividend to purchase more shares. We would also recommend having a further discussion and providing some education regarding your 401k rollover options, and have a fair and balanced conversation. Mr. Kemp's 401k is not diversified, as it just is invested in the one fund, the S&P 500. Also, with Mrs. Kemp, your 401k is just invested in a target date mutual fund that has reached its target year of 2020 and is now conservative. So if you have indeed a very willingness risk when it comes to your risk tolerance, or an aggressive risk tolerance, that would be a mismatch if the fund that you're currently in is conservative. Does that make sense? Great. All right. So a retirement plan analysis was conducted for your retirement assets. And what we found is that you have a low longevity risk. What that means is a low risk of outliving your assets. You have a substantial amount of assets and enough to cover your needs in retirement. One of the strongest factors here is the sources of your guaranteed income. With enough guaranteed income to cover those essential and your lifestyle expenses, there really is a low need to be withdrawing from your investment accounts or your retirement accounts, so that you can continue to have those assets grow for you. And speaking about growing your assets, I know the question was asked of how to continue to grow your retirement assets tax-free. What you could consider is rolling your assets into an IRA and then converting those assets to respective Roth IRAs. The Roth IRAs would be a means to continue to grow your assets tax-free. Now, one thing to note is when we implement a Roth conversion process, the assets that are converted would be taxable as income in the year that we do so. So to avoid a large taxable event in one year, our firm would recommend the Roth conversion over a series of years to minimize that. Did you have a question? Yes, absolutely. We would work, because taxes are involved, yes, sir. We would work with your tax accountant in order to ensure that this is done in an efficient manner for you. Correct. A great question. Now, regarding future contributions to your retirement accounts, it's great. I love that you guys want to, uh, you, Mr. and Mrs. Kemp, want to continue to save for retirement. Now, when it comes to saving directly into a retirement account, the IRS does require that you have earned income to do so. Now that you're retired, there's no more earned income. The income that you do have, it is classified as passive income and therefore doesn't meet the requirements per the IRS in order to contribute directly to the retirement accounts. But we can certainly contribute to the non-qualified accounts that you have in order to continue to put funds aside, should you wish. As we approach Yes, another great question. Yes, as we approach those ages of where you're going to need or be required to take the required minimum distribution, we will certainly look at the most efficient way to do so. Since you don't need those funds to come to you, it's really going to be about what are we going to use, how are we going to use those funds most efficiently in your plan. And qualified charitable distributions are certainly a strategy that we can look at. Yes, sir. Mm-hmm. Oh, that's great. Oh, I'm glad to hear that you have some charities already in mind, Mrs. Kemp. That's fantastic. Yes. Yes, I know that that's a cause near and dear to you. Yes, and also I didn't get into it specifically, but with the investments, we made sure that we won't be investing in any tobacco stocks for that reason. All right, any questions regarding the retirement analysis at this point? Okay, so moving on with income tax planning and also with estate planning. With Mr. Kemp's inverted Jenny stamp, there is a potential for a high federal tax liability if you were to keep it for 10 years with the assumption that it grows at 8% and then we sell it. There's potentially a high federal tax liability. So we would recommend or consider donating the stamp to a stamp museum. And by donating the stamp to a charity, you would be able to deduct the full market value as a charitable deduction and help reduce your taxes. Also, we did calculate for the installment sale, and what we found was the following: was that $910,000 of the down payment would be realized and recognized long-term capital gain, and close to $69,000 of the first installment payment would be realized and recognized long-term capital gain. The investment interest income is currently taxed at the highest marginal rate. So going back to some of the recommendations that we had with the investment portfolio, we would recommend purchasing tax-efficient funds such as exchange-traded funds or even municipal bonds for your fixed income or conservative exposure, since that would be more tax efficient. And when it comes to estate planning, I think you've done a great job of titling your assets. Many of the assets were joint titled, or are joint titled, which is a great step when it comes to estate planning. Also, having a will is great as well, making sure to have that in place. Now, what we found was for Mr. Kemp, there are significant expenses that come with how some of your assets are titled, since they would, in its current state, go through probate. So in order to avoid excess probate fees and expenses, we would recommend some retitling of the assets. Also, while you do have a will isn't extensive when it comes to having the proper estate planning documents, and so we would recommend visiting with your estate planning attorney to obtain power of attorneys and healthcare proxies. And don't worry, this will all be summarized for you as well. When it comes to the specifics of how we would recommend titling the assets, I'm not going to go through it right now as every single line item of what we would change. I would say the highlights here is right now you're using a joint rights of survivorship form of ownership. New Jersey does allow for tenants by entirety, which would essentially allow for further creditor protection. So we would recommend just some of that change, so implementing from joint rights of survivorship to that form of ownership. Also, working with an estate planning attorney to develop a revocable living trust and retitling some of the assets in the revocable living trust. The revocable living trust would provide for privacy and proper management of your assets. So while it's great that you have a will that states how you would want your assets distributed upon death, a revocable trust really takes it a step further, so to speak. It also helps helps in the event if either of you were incapacitated. The vacation home is also currently in sole ownership and subject to ancillary probate. These are large words here, right? Basically, what it means is that you can consider retitling the home in order to avoid unnecessary fees. So we'll help you with that. And when it comes to Mary's universal life policy, we also have some recommendations of whether or not we would recommend changing the ownership or changing the beneficiary. This would really be further discussed with your estate planning attorney once we do the thorough life insurance review to see how we're going to use that in your plan. We would recommend to continue to use the marital and charitable deductions and the annual exclusions to reduce any gifts or gift splitting, to reduce the value of any taxable gifts as well. All right, so really in summary, again, both Mr. and Mrs. Kemp, you have done a fantastic job in your financial plan, and it's an honor to work with you. I'm very happy that Jeff recommended you over to our firm, and certainly, should you wish to onboard as a client, it would be our pleasure to serve you. And just as a fair disclosure, if you did come on as a client to our firm, there would be a referral amount that would be paid to our firm and you becoming clients. And that amount is disclosed in your financial plan as well. But I'm glad to hear that you've had such a great experience with him, and any referral that comes from Jeff is one that we take seriously in wanting to help and improve your financial situation. So in summary, there's really 5 key areas here to focus on for that we would recommend as our action steps. And the first one would be visiting with the estate planning attorney for the proper documents, including looking at a revocable living trust. Also, when it comes to insurance, looking at purchasing the auto insurance policy for the uninsured vehicle, more coverage on the umbrella policy, comprehensive long-term care policy, the Medicare prescription drug plan, and increasing the homeowner's policy as well. we would recommend setting up the emergency fund of only 6 months of expenses and then using the remaining funds to help fund other goals such as the 529 accounts for the grandchildren, also paying off the mortgage, setting aside funds for future expenses such as the vacation and the new vehicle, and then investing the remaining excess emergency fund in the stock market as well. And diversifying the stock portfolio and considering options for the 401ks that you have. Again, really we could develop a robust asset allocation strategy. The next step is, for us, I would recommend that we meet in 2 weeks, and we would go forward with improving the financial plan. So thank you.